Welcome to Markets Now. I'm Michelle Rook with Darren Frye, Water Street Solutions. A higher day in grains and cattle, hogs mostly lower. And Darren, let's talk about the grains because corn got a bit of a shock with the 200 million bushel ending stocks cut that USDA gave us. Were you anticipating that much of a demand increase?
I didn't know if they would do it all in one report. You know, they didn't do anything last month, and I thought they would have done something. But this month they did a lot more than I expected. I thought they'd spread it out. But they must see some evidence to go this far, because 200 million is a pretty big cut, raising 150 on the exports, 50 on ethanol, and all in one report, and the December report to boot. So it'll be interesting to see what happens in January when we get there, to see if they have a yield adjustment and any more demand adjustments. And I would think they did a lot of it, or the lion's share of it, today.
Yeah, and maybe what was also surprising was the fact that USDA really is not pricing in any export loss because of tariff concerns.
At this point, they're not, and that could be a big deal as we move into the 25 calendar year. Some people think that we'll actually do more business. I hope that's the case. I'm not sure I believe that. I think it could be kind of a geopolitical stressor here as we see the Trump administration begin to have a little bit of battling going back and forth with China. The only bright spot, I think, is China's not in the same economic position they were, you know, let's say 6-7 years ago when early in the first Trump administration. And so therefore, they might be a little bit more on their knees and a little bit more desperate to comply with some of that. But other than that, I think it could be a battle here as we get into the new year.
So world ending stocks on corn were also lowered by 7.7 million metric tons. That was above expectations. So with that combined with what we saw with U.S. ending stocks being lowered, did you feel like we had an appropriate response on the board? It looked like it was kind of muted.
It was, and I think that's because of the soybean complex. You know, weather is still going really good in South America, and we just don't see any issues down there to speak of here in the early part of December. Could that change? It could. But for right now, you know, they didn't change the carry out at all for our soybeans. Ending stocks remain at 470. That's plenty. We got a whopper of a crop coming in South America. And I think soybeans kind of muted the rally in corn to some degree. This was a huge change in the balance sheet, more than what the trade estimates were expecting. And you'd think that you'd see double-digit gains in corn. We only saw, you know, 5 to 7 cents. And that, I think that's a result of the soybeans being kind of an anchor to the complex.
Plus, we're up into some resistance areas. Is this enough to get us over those, do you think?
Yeah, I think so. I sure hope so. You know, 450.5 has been kind of that hard wall to break there in the March corn. I think we could break that here this week. And then, of course, my next objective would be in that 465 area. Beyond that, I think it's going to take weather issues in South America to really propel us any higher. But those will be good selling opportunities to do more sales for 24, clean up some sales for 24 if guys are already advanced in their selling. But that's going to be a good rally to reward.
And you mentioned maybe some yield cuts in the January report. Do you expect that, and how big?
You know, I think it's 50-50. I think you go either way, a bushel, bushel and a half, either way. I don't think there's a precedent for which way that has to go. But the fact that they lowered it a little bit in the November report maybe would lean me a little bit in favor of maybe a little bit smaller, a little bit more of a reduction. But I don't think it's anything major. If it is, they're going to light a fire under this market because the carryout is tight enough with this good demand. They can't afford to lose a lot of supply in January.
Gotcha. Soybeans, USDA left ending stocks unchanged. U.S. basis 470. We only raised production in South America 1 million metric tons, but we're still looking at a record crop down there. And what USDA is at for projections is still under some of the private. So how much of a wet blanket is that going to be?
Well, I think it's a huge problem as we get into next year. Obviously, we're going to see if the weather holds out, and the weather, we only have about 6 more weeks and we'll know, hey, that crop is secure, it's big, and here it comes to the marketplace. But yeah, with Argentina and Brazil and Uruguay and Paraguay, I mean, you're looking at production that's 25 million metric tons more than a year ago, and we just don't see demand up that much. And so that will be the wet blanket on the complex. And that also means we'll shift acres when we come into 25 planting season here in the U.S. we'll shift them from soybeans to corn. And that's another thing that I think will cap rallies. And that's why we got to look at 25 sales as well on this rally that we're getting, because I think there's going to be some opportunities there. And will those opportunities be there come spring if we shift 3 or 4 million acres over to corn?
And if South America's crop does confirm here, if they continue to have good weather, do you think that $10 is a little lofty in terms of prices?
Oh, yeah, I don't think we'll hold up. I think any rallies are for selling in soybeans even before corn, but I do think corn is for selling as well. We just got to give it a time to kind of run its course. But soybeans, this $10 area of old crop, $10.40, $10.50 a new crop, those are going to be sales guys have to reward, I think, unless we see a problem that we do not see today that all of a sudden surfaces with weather issues down in South America.
And not only that, but there is concerns about tariffs, even more so there than on corn, don't you think?
Yeah, I do. I think that is a concern. I don't know how you could get away from it. The best predictor of the future is these past performances, past results. We know how President Trump wants to behave, and I think it means that we're going to have some geopolitical stresses that are going to hurt our demand. You pair that with a strong dollar, and that just doesn't speak, positive about our export business as we enter 25.
And we did see a 20 million bushel drop in ending stocks on a domestic basis. That was actually a little bit of a surprise, wasn't it? As you mentioned.
Yeah, it was, and we lowered them from 815 to 795, and not only sure why the USDA does what they do, but they raise exports 25 million, then they raise imports 5 million. Of course, we had a net of 20 million less, and so that tightened things up a little bit, makes it a little bit more interesting. But I do think export demand will remain fairly strong for wheat and strong for corn as we move into, the early part of 25, first quarter, even into early second quarter.
Yeah, we have thrown, I would say, a lot of pretty bullish news at the wheat market in terms of Russia and their lower crop. They've raised their export taxes. They've lowered their export quota, but the market just has been kind of immune to it. Why?
I don't have the answer for that. It's just kind of one of these things where, Russia always seems to have more competition than what we would like or the rest of the world would like. I know Russia says they're not going to export near as much after January. I think it's 11 million metric tons, which normally would be closer to 2025. And so there's going to be these caps put on. We'll have to see if the wheat cares. But right now, the fund managers and the momentum traders keep piling into the short side on every rally, and they just don't seem to have fear about that. If we get into January and it truly is different, then maybe we'll see a different side of that. But right now, rallies are for selling in wheat.
Yeah, it's been kind of crazy, I guess, to watch the fact that we're down at these contract low areas.
Yeah, it's like 4 or 5 days up, and 3
Yeah.
days later, you're back to the lows again. And so that has been real hard on corn. That's why corn has held up so well. And now today, we can maybe see why that has been the case.
All right, that's a really good point that you make there. They've really been tied together for sure. Cattle market, we're up, and feeders have been the leaders. Do you continue to see this market being able to perk along here, because cash has really been pulling the market along?
Yeah, there's a strong correlation to war escalation, and cattle prices. And this goes back a long time in long-term trends. And cattle have been up for a long time. I think they're ready to have a long-term top. But, we haven't seen enough retention. We haven't seen expansion in the herd. We haven't seen demand fall off enough to change any of that. And now we have war escalating in many places. And so I do think the cattle are going to continue to move higher. We'll have to see what happens as we turn the calendar into 25. But a lot of times your major tops are made in that January through April timeframe. And that's what the charts are lining up for. So we'll see if that happens and what price that happens at. But I think cattle could broach that $200 level before they top out here. And that would be, a couple, 3 months from now.
What happens when the border opens to Mexican feeder cattle, though? Will that significantly pull down the feeder market, or is the fact that we have tight supplies and strong cash, is that going to maybe overshadow that?
Well, it'll have an impact. I don't know how much, but it'll have an impact, maybe psychologically first, but then if the numbers are enough, it'll have an impact on prices. But I would say that, if a guy has some lofty prices as we end the year and move into next year, it's a place to put on puts and some hedges just for that type of protection. Winter storms, death loss, weight gain issues, those can propel us higher in that February timeframe. That's usually when that happens, but we got to watch what happens when the border opens.
Yeah. What about outside markets? Of course, we've been hitting record highs here recently in the stock market, or maybe looking at another quarter point cut from the Fed next week. Do you sense at any point in time that people that have put money into the financial sector are going to take some profits and put it over anyplace else, like in the ag sector at all?
I don't know about that. I do think that there'll be a reallocation. Obviously, we see that with the index funds every year. That'll be coming in January. But I do think that the equity markets, the crypto markets, they've been on fire. And at some point, yeah, people will take profits. But I really am concerned when we have this interest rate inversion that's been going on for 25 months. When that totally unwinds and normalizes, that's usually when you start seeing cracks in the facade and problems for the overall market. And that's when we could see profit taking come into the stock indexes. And of course, things like crypto, Bitcoin, those altcoins as well, some of the miners. So I think a guy's got to watch that. But I think until inauguration happens, maybe this market is still going to be risk on until we get past January 20th, let's say. And then we'll see what happens.
All right. I know it all impacts the money flow. So that's why we talk about it for the farm community as well. All right. Thanks so much, Darren Frye with Water Street Solutions. That is Markets Now.